And it's important to remember, though, that if you look at all forms of syndicated financing, the U.S. banks are still the dominant banks, largely because they dominate sort of the middle level of syndicated financing. And here, we're talking about a market that's well over $1 trillion a quarter in terms of additional financing. So the European banks still do the sort of plain vanilla. The U.S. banks still are very dominate plain vanilla syndicated finance. That's Citibank, J.P. Morgan, the very large banks in the region. So here we are with the basic story. European banks are deleveraging. Asian banks step in, but they face heightened funding risk. And this reflects the kind of credit that is being provided. Trade, project finance, that requires dollar funding. And this makes Asian banks particularly vulnerable to dollar liquidity shocks, right? And all of you are well aware of what happened during the global financial crisis, where these markets for dollar funding really dried up. And they dried up also in the fall of 2011. So this is really a key channel of financial contagion from the rest of the world into Asia that is growing in importance as a result of Asia's increasing reliance on wholesale dollar funding markets. And especially in long-term funding, which tends to dry up much more quickly. So if any of you are following the cross-currency swap markets, for example, you will know that those markets stayed quite liquid at the short end, but completely evaporated at the long end. And those markets are key to funding project finance, infrastructure finance, shipping, airplane finance in Asia and globally. So we now come to the issue of policy and what does this change in the structure of Asian finance mean for policy, and how can Asian policymakers manage this financial challenge? And I think if you look at Asia now, you can see that Asia is very rich in dollars. Asian central banks have accumulated huge reserves, dollar foreign exchange reserves, no more than China, with almost $3.4 trillion in foreign exchange reserves. The issue is that Asia is now facing a different set of challenges than it faced in the Asian financial crisis. If you think back to 1997, remember that the Asian financial crisis was really a balance of payments crisis. But now you have very strong balance of payments in most countries across Asia, very strong foreign exchange reserve positions. The new challenge is that the banking systems in Asia are much more dependent on dollars and much more integrated into the global financial system than they were in 1997. And so this involves a new set of policy challenges for Asian central banks. How do they adapt to the increasing dollar liquidity risk facing Asian banking systems? And there are a number of things that they need to do and in fact are doing, because we are talking to them about these issues. First of all, the question is, how do you provide dollar liquidity to banking systems when these banking systems come under dollar funding pressure as a result of a crisis elsewhere in the world? Right? This is an area where Asian central banks need to cooperate by, for example, putting in place foreign exchange swap arrangements with the Fed, for example, but also through initiatives like the Chiang Mai Initiative, which is an initiative that pools $250 billion worth of Asian foreign currency reserves. And these are really ways of channeling dollars to Asian banks that are operating in the region and lending across the region and financing trade between countries in the region, providing dollars to these institutions. And there are also other mechanisms to provide dollars, and that would be through the export credit agencies and the international financial institutions like the International Finance Corporation, the World Bank, and in particular through ECAs or export credit agencies like the Japanese Export Credit Agency. Now, export credit agencies have traditionally provided credit guarantees, but in the crisis they started to also provide dollar liquidity by borrowing dollars and lending them on to banks in order to co-finance infrastructure, project finance across the region in countries like Indonesia, Malaysia, Thailand, Australia. So these are all mechanisms to try and address the volatility in dollar funding that comes about as a result of stresses and financial crisis elsewhere in the world. So, perhaps let me close on some of the other developments relating to dollar finance in the region. I'm sure many of you have heard about the imbalance in Asia between bond markets and debt markets. In particular, foreign investors are very reluctant to invest in Asia outside of the sovereign debt markets because of concerns about the transparency and the corporate governance of many corporates in Asia. But one thing that we're seeing now is really an explosion of dollar bond issuance in the dollar bond market in Asia. And this market is centered in Hong Kong and it's centered in Singapore. And you can see here really issuance that had been stable at around 40, 50 billion has now shot up to over $120 billion at an annual rate. Right? So this is really an extraordinary expansion of dollar issuance. And despite this increase in supply, what we're seeing is unprecedented spread compression in these markets. And what we're looking at here are both corporate and sovereign bonds issued by entities from a range of different countries. And you can see, almost without exception, that these spreads are at the bottom end of their range, despite the fact that issuance is triple what it was only a few years ago. And when we go and talk to the investment banks and the managers who are in charge of this issuance, they are telling us that you can now easily do $1 billion or more issue for a good corporate name, and that many of these same issues are 3, 5, sometimes even 10 times oversubscribed. So really, what you are seeing here is a massive appetite for sovereign debt in the region that is really now opening up the possibility for a transformation of Asian finance to away from banks to debt markets, to deal with a situation where Asian banks are now also running up against constraints on the funding side, because with Basel III, funding will become a lot more costly, and also on the capital side, because under Basel III, they have to hold more higher quality capital at a time when credit is growing at a very rapid pace. Now I'm going to stop here, and some of these latter issues that I mentioned we can cover perhaps in the question and answer period. And these are questions having to do with how could the structure of Asia finance change, shift to capital markets from banking systems, what is happening vis-a-vis the debt markets and the equity markets, and in particular, what is the future of Chinese banks in Asia. But I know that there are many of you here. There's a panel of very knowledgeable experts and the master chair. So let me stop here, and let's then reserve many of these other topics for the discussion.